Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today, with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session.
Let's move on to debt service coverage ratio and an analysis. See, debt service coverage ratio is a ratio which is going to measure the repayment capacity of the borrower. So how this repayment capacity is measured? We know it is debt service coverage ratio, but again that is divided into three. We have gross DSCR, okay, then we have net DSCR, and we also have average of gross DSCR, average of net DSCR. So within debt service coverage ratio itself, we have almost 4 types of debt service coverage ratios. So what is gross DSCR? What is net DSCR? Let's see. When we say gross DSCR, we are going to consider the gross cash flows available for servicing the total repayment obligation. Okay, so we can say gross cash accruals. So what is gross cash accruals? It is PAT minus dividend plus depreciation plus interest on term loan whole divided by interest on term loan plus principal repayment. Okay, so this makes gross DSCR. Public sector banks will be insisting it should be at least 1.75, or some banks will go up to the down level up to 1.5. Then comes net DSCR. What is net DSCR? Here focus is on the cash flows that are available for servicing the principal. It means we'll take PAT minus dividend plus depreciation divided by principal repayment. In general, this net DSCR will always be greater than gross DSCR, because gross DSCR is also looking at the servicing of interest, okay, whereas here from these cash flows we are focused only on servicing of principal. Okay, so this ratio is expected to be higher than gross DSCR. Okay, so if minimum gross DSCR is expected at 1.75, net DSCR should be greater than 1.75. If minimum is expected to be 1.5, net should be greater than 1.5, and obviously it will be greater. Okay, so some banks will prescribe level like net DSCR should be at least 2 times or 1.75 times, as the case may be. Okay, now let's take a real DSCR computation of a original company. Look at here, you are given the DSCR computation. It is DSCR computation for how many years? Year 1 to 8. And for information purpose, only for information purpose, not for calculation purpose, net sales are given 27.6 crore and expected to increase to 38.2 crore, sorry 82 crore, and after that it is freezed. Okay, so it is freezed here. It means no year-on-year increase in net sales are projected. Okay, this is basically on the conservative side, but in reality year on year it can increase, but here the bank is going on very conservative calculation. Okay, so there is almost 10 plus crore increase from 27.6 to 38.82 crore. Okay, fine. Now here you have the net cash accrual calculation. This is something which they have picked up from CMA. So what is net cash accrual? It is PAT minus dividend plus depreciation. Okay, So when they did this calculation, they got 4.49, 6.1, 6.14, 5.71, 5.98, 6.24, 6.72. So for 8 years we have, and all this added together is 47.87 crore. This attains significance especially when we are looking at gross average DSCR, which you will understand shortly. So this is net cash accrual. With this net cash accrual, term loan interest is now added. If you recollect, here I have said it is PAT minus dividend plus depreciation plus interest on term loan. That interest on term loan is what we are writing separately here. So this is the term loan interest, which is again picked up from CMA. Okay. Now these two are added. So total sources is nothing but item number 1 plus 2. So we have total sources. This is total source for year 1 to 8, and if you can notice, it shows some kind of a fluctuating level. Look at here, 6.77, it goes to 8.75, then it comes down every year. It comes down every year, and it is coming back almost to the same level like 6.79. Okay, and why this is happening? This may happen because net cash accrual is influenced by depreciation. Okay, and year after year when you add back depreciation, the depreciation levels, that is going to have impact. And look at the term loan interest also. The term loan interest is coming down year after year, so that's also having impact, right? So this is total sources. Then let us have a look at the total installments. Let's see. Yeah, now we'll focus on obligation. The first one is term loan installment. That is, what is the repayment fixed for each and every year? This is something which we have to pick up from the repayment schedule. I mean, existing loan repayment schedule, proposed loan repayment schedule, everything should be added here. And if you can notice, all 8-year figures added works out to 22 crore. Then term loan interest, and this term loan interest is nothing but what we have already captured over here. Okay, whatever we have captured over here, that is again coming back here. So in the numerator also it is factored. Look at here, in the numerator also it is factored, and denominator also it should be factored. Okay, so in the denominator also you can see the term loan interest, same numbers, 2.28, 2.28, 2.6, 2.6, like that. For each and every year we have that, and eventually check the total, 11.7 crore, 11.7 crore. Now let us total the uses. We'll total the uses, that is sum of these two, 3.85, 5.8, it goes, and so we have the total uses as 33.7 crore. Okay, now let me clear all this. Yeah, so this is the total source and this is the total use. If this total source is divided by total use, what you get is gross DSCR, because this is nothing but PAT minus dividend plus depreciation plus term loan interest divided by term loan interest plus term loan principal repayment. Okay, so that gives gross DSCR. So 6.77 divided by 3.85 gives you the ratio as 1.76. It is good because it is greater than 1.75, which many public sector banks will insist. But certain banks are okay if it is greater than 1.5. So here this DSCR table is picked up from the bank which is accepting DSCR at the 1.5 level. Okay, so for them in year 1 this 1.76 is an attractive ratio. Look at year 2. They had source of 8.75, whereas the repayment obligation is only 5.8 crore. So 8.75 divided by 5.8, you get 1.51. But still this is okay for that bank because it is greater than 1.5, because I told you this bank accepts DSCR at 1.5 level. Year 3, 8.36, whereas total uses are 5.36. So 8.36 divided by 5.36, it is 1.56. That is the DSCR. 8.36 by 5.36, it is 1.56. It is also greater than 1.50. And if you notice, every year the ratio is maintained above 1.5. But why it is high in first year and it is coming down in year 2, 3, 4. Let's analyze. Let me see. Sorry. Yeah. See, in year 2, sources have increased actually. From 6.77, it has gone to 8.75. But on the other side, look at the term loan installment. It got doubled. Okay. Term loan interest also increased. So the increase from loan, that is 8.75 minus 6.77, the increase is only 1.98 crore. But here, if you note the increase, 5.8 minus 3.85, it is 1.95. Okay, so there is almost equal increase. That's why DSCR could not be maintained at the same level. See, denominator should come down ideally. When numerator increases and when denominator is also increasing at the same level, DSCR will come down only. When numerator increases, if DSCR, the denominator remains same, DSCR will increase. But here both of them almost moved in same direction, so DSCR has moved in opposite direction. And look at here, from 8.75 it is coming down. When it is going up itself, the ratio is not improving, it is coming down. And one relief is total uses has come down. Okay, so that is going to give a relief, and that's the reason from 1.51 it had increased to 1.56. Okay, fine. Then in year 4 it is coming down even further, and to the rescue, uses is also coming down. This is coming down, which is bad sign. This is coming down, which is a good sign. That's why the ratio is maintained above 1.5 itself. Then in year 5, sources 7.32, uses are 4.48. So now it is on improving trend and it is improving year after year. So what we should be concerned is whether the net cash accrual is showing a dip. See, from 4.49 it has increased to 6.1, 6.14. From there it had come down to 5.71 in year 4. Why it is coming down? Because DSCR is lowest only at these 2 points, 1.51 and 1.52. Okay, only at these 2 points DSCR is at its lowest. So why this net cash accrual is coming down in year 4, that got to be analyzed and brought out in the proposal. Okay, but if you notice, throughout gross DSCR is maintained above the generally expected level of 1.5. Okay, so this is gross DSCR. We also have the concept called gross average DSCR. How this gross average DSCR is calculated? See, look at here. You had net cash accrual, right? This net cash accrual for all the years are added here. Then term loan interest for all the years, that is also added. 47.87 plus 11.70 gives you 59.57. This is total source. Similarly, total installments are here, total interest is here. If you add these two, you get 33.7. So 59.57 is the total source for this project period, and 33.7 is the total use. So 59.57 divided by 33.70 gives you the ratio as 1.77. So gross average DSCR is greater than 1.5, which some public sector banks are okay with. It is also greater than 1.75. So gross average DSCR is expected to be satisfactory, but it is very close to the expected level. So sanctioning authorities may have some apprehension whether these numbers are really cooked up to get the minimum ratio. Okay, so you should have a solid justification whether these numbers are reasonable, okay, whether these numbers are achievable. Then comes net DSCR. Net DSCR, as already I said, it is going to focus only on principal repayment. That's why you are going to take only the cash accruals before adding this interest on term loan, and that is compared only with principal repayment. Look at here, this is your cash accrual 4.49 and this is your principal repayment 4.49 divided by 1.57 is giving you 2.86. This is your net debt service coverage ratio. 6.10 divided by 3.14 will give you 1.94. Like that you can calculate for each and every year and look at the total net cash accrual 47.87. And what is the total term loan installment? 22. 47.87 divided by 22. Let's see, 47.87 divided by 22 will give you 2.18, and this is the average net debt service coverage ratio. So this is how gross DSCR, net DSCR, gross average DSCR, net average DSCR are calculated.
Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You're going to get access to various financial ratios ebooks, financial management related ebooks. You'll get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.